As the U.S. market is currently closed, we are looking at the figures from the previous session and the current pre-market activity. Lithium Americas Corp., trading under the ticker LAC, finished yesterday's session on October 20, 2025 at $6.97 per share, a solid gain of 2.72% on the day. But the real story is what's happening right now, before the opening bell. Pre-market indications are showing the stock active, trading around the $7.10 mark, and after-hours trading last night saw it spike significantly higher, briefly touching levels near $7.49. This isn't just random nervous energy. This is the market trying to price in a development that fundamentally changes the entire narrative for this company. Yesterday, Lithium Americas confirmed it has received the first drawdown of $435 million from its monumental $2.23 billion loan from the U.S. Department of Energy. This isn't just another press release. This is the sound of the engine turning over. This is the moment the company shifts from a high-stakes speculative blueprint into a fully funded, large-scale construction project. The expectation for many investors who have been watching this name, perhaps adding fractional shares on their Robinhood app or through their SoFi Invest platform, has always been that LAC is a binary bet on its Thacker Pass mine in Nevada. The belief was that you buy it, cross your fingers that it navigates the permitting hellscape, and hope it eventually finds the capital to build. It was viewed as a high-risk, high-reward play, a lottery ticket on the EV supply chain that many use for self-investing as a pure speculation. That expectation, however, is now dangerously outdated. The reality is that Lithium Americas is no longer just a mining company. It has transformed into a critical piece of U.S. industrial policy, a quasi-public-private partnership. The risk profile has completely inverted. The old risks were permitting and funding. The new risk is execution. Let's be very clear about what this U.S. government involvement means, because it's far more than just a loan. As part of the finalized loan amendments, the Department of Energy is not just a lender, it is now an owner. The DOE is receiving warrants that give it a 5% equity stake in Lithium Americas, the parent company, and a 5% economic stake in the Thacker Pass joint venture itself. This is an incredible development. The U.S. government is now a partner, its interests directly aligned with shareholders in seeing this project succeed. This isn't an investment you just toss into a Schwab Intelligent portfolio and forget about. This is a company that is now at the center of the push to secure a domestic supply chain for critical minerals. This move signals that the government views this project as too important to fail. This is the kind of validation that goes far beyond what any Wall Street analyst or investing sites report could provide. It's a level of backing that separates LAC from nearly every other junior miner on the planet. Let's look at the recent stock movement because it tells the story of this transition. The stock has been agonizingly volatile, trading in a 52-week range between $2.31 and $10.52. This is not for the faint of heart. This is not a stable blue chip like Apple stock. This is the kind of volatility that Interactive Brokers trading platform users thrive on. But the recent action, this pop to close near $7, and the continued strength in the pre-market is directly tied to the flow of information about this funding. The company didn't just secure the loan, it just got the first check. That $435 million is now in the bank. This drawdown triggers the next major phase of construction. This isn't theoretical capital, it's tangible. Along with this, the company also just announced the completion of its at-the-market or ATM program, raising $100 million in gross proceeds by selling shares. For many stocks, an ATM program is a headwind, a constant drip of dilution. But the completion of it is bullish. It means the raise is done. The market has absorbed those shares. Between the $100 million in cash from the ATM, the $435 million from the DOE, and the massive $625 million investment commitment from General Motors, Lithium Americas is, for all intents and purposes, fully funded for the construction of Phase 1. This is where the story gets even more compelling. General Motors isn't just a customer, it's the other key partner. GM owns 38% of the Thacker Pass joint venture, with LAC owning the other 62%. GM's $625 million investment and its 20-year offtake agreement to buy 100% of the output from Phase 1 provides the demand-side certainty that complements the DOE's supply support. This three-way lock, LAC's resource, GM's demand, and the U.S. government's financial and political backing is what the market is finally starting to understand. The news yesterday also included another crucial detail. As part of the new agreements, GM has amended its offtake to allow Lithium Americas to sell certain remaining production volumes to third parties. This is a masterstroke. It means LAC isn't locked into a single customer agreement for its entire output. It can now diversify its customer base and potentially sell a portion of its lithium at higher spot prices, giving it massive operational flexibility. This is the kind of detail that sophisticated investors using a Fidelity trading platform or a full Fidelity brokerage account look for, as it significantly de-risks the future revenue stream. Of course, we have to talk about the macro environment, which is the major headwind and the primary source of tension. The entire lithium sector has been crushed over the last 18 months. A massive wave of new supply, primarily from Australia and China, collided with a slowdown in EV sales growth, and the price of lithium carbonate fell off a cliff. This is why the stock is at 7 and not 20. The market is looking at the current low spot price and is worried about the project's future profitability. But here is the critical distinction. Lithium Americas is not a producer today. It is a developer. Thacker Pass isn't expected to commence production until 2027. Therefore, the investment thesis for LAC is not about the price of lithium in 2025. It's a bet on the price of lithium in 2027, 2028, and beyond. And by that time, forecasts from groups like Goldman Sachs suggest the current glut will have been absorbed by a relentless increase in EV adoption and grid-scale battery storage, leading to a much tighter market and higher prices. The DOE and GM backing is the bridge to get from today's low-price environment to that future higher-price environment. For those unfamiliar with the company structure, it's important to understand what Lithium Americas is today. This is the new Lithium Americas. The company executed a strategic split last year, separating its North American and South American assets. The company we are discussing, LAC, holds the 100% interest in the Thacker Pass project in Nevada. The Argentina assets, including the Cauchari-Olaroz project, were spun off into a new independent company, Lithium Argentina. This separation was brilliant. It provided investors with two pure-play options, one focused on a stable domestic U.S. jurisdiction, LAC, and one focused on a producing but geopolitically complex asset in Argentina. The new LAC is a pure bet on Thacker Pass, which is the largest known measured and indicated lithium resource in North America. Phase 1 is targeting 40,000 tons per year of battery-grade lithium carbonate, enough to power roughly 800,000 electric vehicles. The company is using a national construction agreement with North America's building trades unions, locking in labor stability. The EPC, or Engineering, Procurement, and Construction Management contractor, is Bechtel, one of the largest and most respected engineering firms in the world. This brings us to the future outlook and the new set of risks. The expectation is that with funding secured, the stock will just climb. The reality is that the risk has simply shifted. The primary risk is no longer financial, it is execution. Bechtel and the LAC team now have to build a highly complex, first-of-its-kind lithium carbonate processing plant in the Nevada desert, on time and on budget. The $2.23 billion loan is massive, but large-scale industrial projects are infamous for cost overruns and delays. This is the new hurdle. Every online investment in a developer carries this risk, but now it's the only risk that truly matters. Investors managing their individual brokerage accounts need to watch for quarterly updates on construction milestones, first concrete pour, arrival of long lead time equipment, and adherence to the 2027 production timeline. The second risk, of course, remains the lithium price. The DOE loan terms are favorable, with interest at U.S. Treasury rates, but repayments are scheduled to begin in 2029. The project's ability to service that debt comfortably will depend